Hi traders all, welcome to TCM Education. In this video we want to discuss some of the trades that can lead you as a day trader to, I don't want to say extreme profitability, but reasonable, repeatable profitability using only a small fraction of your account buying power, not that I know that each of you has in your account, and obviously if you are a US day trader or US investor, you have more money versus I would say Australian, Israeli, or maybe Indian, although it's obviously none of my business. The idea here is that you use a fraction of your account, not 1%, but a fraction, like 20%, 30% of your buying power. In the US, most of the accounts are at least 30 to 50 grand. That means a 200, up to 200 times 4 intraday. So that's, let's say, at least 100 to $200,000 of buying power. In using this strategy, you can use obviously your whole buying power, but I'm suggesting doing it methodically. And so you use per position $20,000. Now, if you don't have the $20,000, use 10,000. If you don't have 10,000, use 5,000. If you have the buying power, you can use 40,000. I suggest that 20,000 is reasonable because you can reach extremely great numbers using our strategy, which is the smart trading strategy, and using the power lists and some of the watch lists. You see immediately what I mean. And the idea here is that you never risk more than 1% per trade unless there are special circumstances, and you can risk 1.5% per trade. That's another, in this case it's going to be, instead of $200 per trade, which is applies to $20,000 per position, you're going to risk another $100, and or you lower your position. So it's again, the numbers are very flexible. That's the great thing about this strategy. You don't need to buy 100 shares per position or 1,500 shares per position, not to mention buying huge positions. No, it's your decision. You don't buy shares, you buy a money position, like in our example 20 grand. Okay, that really applies very well to a US day trader. May not apply to a foreign day trader, but again, you're flexible. I don't know how big your account is and how many people will be watching this video. Okay, so that's the concept overall. Now let's see how you can immediately in the morning observe what's going on. You can see here the list of leading stocks, leading ETFs. Okay, those are the leading ETFs based on the sector. So you can see Jets up 7, while the rest of the market is hovering near the flat line. Okay, so earnings in Delta. Obviously, if you are a day trader, you must know that there were earnings in Delta. But let's say you didn't do your homework. This list does the homework for you. It tells you airlines are booming. And that was early in the morning already. The airlines were up 5 or 6 or 7%. And if you went to the stock screeners, Delta, United, all the Southwest, all the American, all the leading ETFs, stocks in the airline sector, which I'm using this ETF Jets because it's easy to remember, number 1. And then there were some stocks that we never trade from the mining sector, and the rest of the sectors are not very, we don't care about them unless it's semiconductors. So, and financials obviously. So let's move now to the S&P 500, and you can see I have to search it here in the list because look where it is, near the bottom. The S&P closed 0.28, that's the closing numbers that you see here, and the airlines closed up 7. So that's a huge disparity between the market S&P 500 and airlines. And how did the S&P traded yesterday? Let's move to the 5-minute S&P. So it started with a move lower and then traded higher for basically for almost the whole day until nearly 3 p.m. and then dropped half of its profits, half of its 0.6 achievement at the highs, the 626.87. I think it's also near all-time highs or at all-time highs. Yeah, it is all-time highs. We touched it. I mean, we barely breached the all-time highs by a couple of cents. The market retreated. You can see the range was very narrow. So the S&P 500 didn't do a favor to anybody the way it traded yesterday. Horrible. Okay, so airlines are clearly the place to look for a trade. Guess what? Let's now move to our screeners, and obviously we want to see long screeners, basic longs. And if you are focusing in the morning, okay, you had no problem watching Delta, United, American, Southwest, and maybe others. But who cares about the most liquid are American, United, Delta, and Southwest. So you need to pick one of them. Let's see one of them actually, United. Now again, who cares? And this is a mistake that we as day trader, some of us do. We think $87 is expensive. It's not expensive. You don't have to care about the price of the stock. Okay, it's maybe a bit spreadier. That's true. Then American, which is at $12. How much? Yeah, American at $12 is more tight. You can buy more shares, but it absolutely does. When you use this strategy where you buy a money position in it actually benefits those who pay commissions. In the US it doesn't matter because we don't pay, not we. Those who trade in the US with a US broker don't pay commissions, and you can buy, I don't know, maybe an unlimited, I don't know the deals per broker. I mean that's impossible, and I'm not gonna dwell into that, but let's say you want to buy a $20,000 position of United and the price is $88, and I'm immediately doing the calculation, and of course if you can do it on your platform, even better. So it's 20,000 divided by 87, and it's 230 shares. So let's say you pay commissions per 230 shares, which is less than you would pay for a $12 stock, where you have to buy 5 times more. You'll buy 1,000 or maybe 1,200 shares. Again, not a factor at all. I'm excluding the commissions out of the discussion because most of our viewers are US traders. US probably are using a US broker, probably are not paying any commissions, and if you pay commissions, they are, I don't want to say negligible, but they are on 229 shares. I don't know how big the commissions are, $1, maybe $2, let's say $2, so it's not a factor. Bottom line, the stock breaks the first high of the day, reminiscent of the Nike trade that we discussed a week ago or 10 days ago, I don't remember. But this is obviously a strategy that can be applied, okay? If you want to use it and you know the risk, okay? If you don't know the risk, you cannot take the trade. In this case, the breakout was 87.80 or 85, and the risk was down to the 87. So that's an 85-cent risk, and you're willing to take the trade risking 1%, which is exactly 1%, maybe 1.05%. So that's again negligible. And on $20,000 you risk $200, and the math is scalable. And now what do? Okay, most of us on a normal day will take profits, will cut the position in half, will elevate the stop loss, will do all kind of weird stuff just to cut into our profits and manage the trade. And the strategy that we're using here at TCM is totally different. It's basically no strategy in terms of managing. Let the trade evolve, and then after the trade evolves, you make a decision. Overall, you want the trade basically to close, to sell at the close, assuming you bought the right stock and it's going to close at the highs of the day. Now, what is the worst case scenario that can happen is that you lose that 1%, which was your assumption. So let's say the stock is up 5% in the money and comes down 6%, and you didn't elevate your stop loss to the entry, and you lost 1%. Obviously, that's stupid. We're not suggesting that type of strategy. The idea is that after 1% in the money, you elevate the stop loss to the entry and you have zero losing trade. And then the question is how much money you're going to make on the trade. 1%, 2%, 10%, or whatever percent. Okay? So we're not talking about cents. We're talking about percentages. Why? Because we are looking at those intraday trades that are not going to make us 20 cents or 50 cents. We want percentages anywhere above 3 to 5, maybe 10. One 10% trade with a $20,000 position, you know what it means. It means $2,000 per one trade. But that's not going to happen very often. It happens. We've seen plenty of examples. I have a playlist ready for you to be launched in hopefully where you see that the potential is just unbelievable. And it is under our eyes. You know, the great trades are hovering. Of course, there are pitfalls. It's not very easy to day trade after all. But, so this trade makes 4% overall. When you wait until the close, how much do you have to wait? 6 hours you have to wait. What's the problem with waiting 6 hours? There are some issues. Some people are very impatient. They want to take profits immediately and move to another trade where they're going to lose. Let's say you take 3% here and you take 2 other trades, you're going to lose obviously one here, one there, and you end up with a 1% winner, which is $200. So you're going to work for $200, 3 positions. That means if you are an amazing on the next trade, you're going to make another 3%, and then you lose another 2% on 2 other trades. It's impossible. So you need to let the stocks do the work for you. Don't do anything. I talked about this strategy, I think, so many times. Anyway, that's an option. Obviously, everybody runs his own business. You can do whatever you want. I'm suggesting this, I think, unique strategy based on observing what's going on in charts, and that's why we are called the charts maverick. For 20 years, nearly 5 hours per day. You do the math, how many hours is before I'm using actually I'm trying to implement this strategy for years without success. It's hard to implement because you need to be very patient, and those who are us who traded 20 years ago, and 20 years ago the volatility was totally different. You used to buy a stock, 20 cents later you sell it. It was a different ball game. Okay, so here is a trade that makes us 4% if you wait, and this is the strategy. Obviously at one point it was up 6%, but you don't know that 98, 70 is the highs of the day. You want it to close at 95 basically. The assumption is that when the trade moves higher, pulls back and does this. Okay? Obviously, it's not guaranteed. It can do exactly the opposite. And then you end up with 0. So that's the worst case scenario. 0. There is no losing scenario on a successful trade. Okay? We've seen stocks that moved up 10% intraday and lost that 10%. But we're not, let's put it this way, oblivious. If the stock is going to move up 8% or 10%, we will elevate the stop loss. So it's easily clear that you can elevate the stop loss to this level. And then after this move higher, the pullback, it's very hard to elevate the stop loss because this pullback is not over. So there is a random place, maybe under the VWAP will be your worst case scenario. And again, so if you stop out at 91, it's not 94, 93.80. That's, you lose here 3%, which is $600, which is a lot for one trade. Okay, but you lose out of your profits, and sometimes, and again, you never know what happens. This one can run in the first hour 2-3% and make you a king here. With, instead of making 4%, you make 8%, and 8% is a huge winner on a $20,000 position. That's basically way above our intraday goal, which is 5 to 6%. And again, we need to take account losses, and there will be losses. Okay. So that's the first trade, 4% on this trade. And again, the visibility, the way to approach this trade, very easy, not trivial. Hold on a second, guys. Sorry about that. My Dutch hund is in disapproval of my strategy, I guess. Okay, so coming back to the concept. Okay, assume nothing. You don't know, I don't know. Watching charts, we know that many times the moves are I don't want to say random or at random, but they are. So if you are able to foresee into the future and know that after reaching 98 it's going to move down, whatever. We're not assuming that. We're assuming a very simple concept, again, without taking partials, without adding. All those concepts are not into this, not taken into account. So that's obviously the easiest trade to observe, because airlines were the best place to look for a trade early on. Okay, so what's the next second place where you look for a trade is a stock like, hold on a second, guys. The second place where we want to go and look for a trade is the material sector. And obviously we have our daily power list, and take a look basically at METC. The range percentage, which is obviously for those who are following us, the most important, the most important factor in this list, in this screener for METC is 23. And we want the number to be above 10%. And most of the stocks at the bottom you can see here are above 10%, and you don't know when those enter the list. Maybe they entered the list in the last 5 minutes. It's clear that METC at 23% did not enter at the last 5 minutes. Okay, so let's look at the chart, okay? Because it's on the winning screeners. Okay, so what happened with METC? Huge gap up. So the stock gaps up. It's a $15 stock, and again, those who love the teen numbers can easily track this one. It traded yesterday 7.7 million shares, but it started with a huge gap up. Okay, and ended up with up 30%. So that's a red flag, because a too big a gap up can also trigger a sell-off. Okay, so before we make the research, why did the stock gap up and what happened, take a look at the price action. It's very volatile. Okay, so you need to observe here. Fight the round number like 15 or 15.50. If you do it, you can enter this trade with very tight stop loss on this pullback. So again, we're looking for a leg up, a pullback, and then an entry. Okay, an entry where the stock turns around, but in case we fail, in case the stock fail, we have a stop loss. And this is the structure here. The stock moves up, pulls back, you have the structure, which is 20 cents, so a little bit more than 1%. And the same strategy. I mean, you can see that there was a nice move over this 15.50 at one point, and it never breached the stop loss ever since it moved over 15.50. So the stock closes at, and again, it spikes at one point for a split second to over 17. Obviously, this is impossible to oversee or take profit on. And again, where is the stop loss? Easy. The stop loss can go from the green line, 1550, and then travel under the VWAP. So your worst case scenario is that you exit at 1610 or 1620, which is 3 or 4%. How much is it? 4%. Okay. And in this case, it ends up closing at 1660, another 2%. So this whole move is basically 6%. And the risk was 2% or 1.5%. So that's 1 to 4. That's also important for us. We want to see risk reward of 1 to 5, 1 to 4, if possible 1 to 8 or 1 to 10. But it's not like we can pick the best trades, the right timing. You'll see that it's tough. It's tough to pick up. We have 6,000 shares. So we're trying using the list, the screeners to take out weed out all of the stocks that are not complying with our basic demands, which is liquidity, which is obviously range, but we cannot search for trend, for example. I don't know if I want to, but the trend changes so many times, so I don't have an indicator that can pinpoint me to a great trend. And again, what is the trend in this stock? So it's up, then, and you need to define the trend by minutes, so it's down. Again, the trend is higher all day, but the important thing is not to buy the position at 1650. You want to buy it cheap. At 1550 is a great deal. At 1650 is no, this trade means is meaningless. And again, you don't know that it's going to close here at 1660 or make this move, break the highs, or even we've seen these events before. Okay, now that's trade number 2. So we had 2 trades. The first one delivered near 4%. The second one delivered 6%. So we have 2 trades, and basically the daily target is reached. But again, yesterday there were so many good movers. I mean, look at the lists that I'm pointing in front of you, and you can see that I have 5 lists that I'm searching from. Okay, basic shorts, basic longs. The most important is this one, the daily power list, and I have a long screen and a short screen, and I'm playing with parameters, always looking for trades. I have more experience, obviously, than most traders, and I know how to, or exactly where to look. Okay, so if I see FTNT on the list, I'm going there for FTNT. While if I see Helen of Troy, I immediately not looking at this stock. Why? Because it's spready, the liquidity is horrible, and there are stocks that I never traded, like VRT. And if you want to see, guys, one of the amazing moves yesterday, VRTV Holdings. I mean, the stock opens at 128 and drops to that's an $18 drop. That's nearly 20%. Sorry, 128 to 110. That's 20. Yeah, that's okay. Not 20%. 16-17%. And this move ends at 10:45. So look at this move. Can you be part of it? If you observe it, yes, you can be. Can you take it with very little risk? I don't know. The spreads, the liquidity, I don't know what happened here. Obviously, it didn't gap down, so there was no signal. But at one point, it's down more than 5% or 6%. It hits all the screens. Okay, so when it hits the screens, you need to assess if you want to enter a trade that drops like a stone and continues. But there are no guarantees that it will continue. Again, can you observe it very late and then face a brutal reversal? Yeah, I mean that brutal reversal started at 110, but it could start at 115. Anyway, this is obviously the best intraday trade yesterday, but that's not part of our discussion anyway. Okay, so stock number 3, boring. Okay, but again, very easy to observe. And this is a Chinese stock. Again, why it's very easy to observe? Not because anybody here in the room, including me, are following BEKE ever. Okay, there was a time, like, I don't know, a couple of years ago, maybe 5 years ago, when the stock was $50. It was a good mover. Now it's $19 or $18. It's not a good mover. We don't care. But look at this gap up. So this gap up basically sends from 18 plus to 19 plus. That's 5 or 6%. So this huge gap sends this stock to our watch list. Okay, and now can you trade this one? It has, I know because I traded it before, it has great liquidity. The spreads are 1 cent. And take a look here, you can take a trade with a 10-cent risk. That's a $20 stock. The risk is 10 cents. So it's not 1%, it's half of 1%. So the risk here is minimal. So you risk $20,000, the stop loss is worth $100, which is amazing. Which means you can buy $40,000 worth of BEKE and risk the same $200. But we're not gonna dwell into that because it's complicated, and I don't know how you people think, and the decision can change. Let's sit with the same strategy, only a fixed position, no matter what, which is a mistake, but for the purpose of learning what to do here and not changing our mind every other entry. So this stock ends up with at one point 40 cent winner, which is 2%, but it's actually 4% because the risk was 0.5%. So again, that's a 2% winner. What is the work done here in this stock? Nothing. You don't do anything. You just enter the trade and let it move. And you are unlucky. We are very unlucky that it didn't close at the highs. But what's the difference for another 19 or 20 cents? I mean, we've seen so many weird things happening. Okay, so and again, take a look at. There was almost absolutely no risk on this trade. 10-cent risk means no risk. Okay, now let's move to the real winners. Two winners. Let's look first at FTNT. Again, from the list. I already did the homework, so you can see. Again, can you be in this leg down in FTNT? Yes, you can, but it means that you're following, instead of following in the morning delta, where you had a flashlight pointing to it, or United or American, okay, you go to a stock that shows you nothing basically, and then drops, which is fine, but you had absolutely no reason to be here. No reason to be here. Okay, sorry again. So again, the concept is that the move or the early morning move is out of the questions because let's face it, we're not focusing on FTNT, we're focusing on Delta and United and airlines for trades. But now it reaches our screener, and then it moves up and down, and we love on a weak stock to take into account the VWAP. So any breach of the VWAP is in danger of returning the stock to basically to over the VWAP and up. This stock doesn't do it. You can see that it touches basically the VWAP area and immediately turns around. That's a signal of a very weak stock. And the market is not very weak, but this stock is very weak. So we don't have any clues from the market yesterday. Actually, the market is trending at this point mostly higher, very, very slow. FTNT, for whatever reason, we're not going to research it, obviously, why. It's moving lower. So again, the trend continues to be sideways, and in this event it fitted the strategy. So we want the stocks to close at the low. So far we analyzed three stocks, none of them closed at highs. United was a long trade, METC was a long trade, BEKE was a long trade, and this one actually closes at the bottom of the trading day. So if you stick to the strategy, instead of and using this 103 short entry in the work, obviously other entries way better, but let's stick to this strategy. 103 down to 100, that's $3, that's 3%. So if you do anything else, you cut your profits by 50%, easy. Any mistake here, and you cut your profits. And again, 3% is not a big, win here. But take into account the real deal on this trade is that this channel between 103 and 103.30 is 30 cents. That's 1/3 of 1%. So basically, if on a $20,000 position, we're risking here $70. Let's say slippage, $80 or $90. So the risk here is half of the normal risk on a trade. Okay, so worst case scenario is $80 to $90 versus $200 on a normal trade, and the outcome is 6 times as much. So here we're talking about a 1 to 6 risk reward. Okay, so the outcome is 3%, but the RNR is 6 to 1, which is this is an amazing number. Good luck finding trades that fit this risk reward. Any trade that fits eventually, you don't know. You know about the risk. You don't know anything about the reward. But if the risk is not 1%, it's half of that, you know that you're already in the right place, because you cut your risk not by 0.01% or 1%. This is 50% less risk. That's a substantial number when losses are going to pile. And there will be days when losses are going to pile. And we will on average need to take into account a 1-to-1. So on each winning trade, you're going to have a losing trade. Okay, it's very easy to lose when the stop loss is so narrow. But you need to apply yourself, apply the strategy, search, do the job, and more important than anything, let the stocks evolve, and this one evolves for you. So if you're aggressive a little bit, and instead of using a $20,000 position, you use here $40,000 position, which is basically the same risk, you have here a 3% on 40 grand, which is 1,200 on this not miserable trade, but on this trade that you're lucky that it closes at the lows. Okay, and the last trade, guys, which is obviously the best one, because we keep the best for last. CRWV. And again, the same concept. You're missing on the big early move. Why? Because you're looking at elsewhere. And if you're looking at CRWV, you have an inspiration? No, we don't trade inspirations, but we do trade technical patterns and weak stocks short and strong stocks long. And take a look at this example. So there is a trade from the view up exactly like FTNT. Exactly. From the view up, down. Okay, and the entry is anywhere, okay? But you must use the view up as a stop loss, which is 148. So you can enter at 146, you can enter at 147. Anywhere you enter, the stop loss, in this case, you use the resistance as your exit, and you enter anywhere. But you know that the stop loss will be over 148. But this is not a great trade, okay? Because you don't know exactly what you're doing. You don't have a clear entry point. Take a look at the next challenging, let's call it consolidation. So we have 1, 2, 3, 4, 5, 6, 8, nearly 8 3-minute bars. That's almost half an hour to decide if you want to short here. And here the risk is, instead of being a $1.50, which is 1% on a $146 stock, the risk here is 50 cents. And again, pretty much like the previous example, 1/3 of 1%. So the risk here on a $20,000 position is not $200, is $60 or $70. Let's call it 70 with slippage and spreads, because Corway is sometimes trades in a nasty manner. Let's take all of that into account, 0.5% of risk, and so the stock dives from 145, let's call it 146 to 138. That's $8 out of the $10 that the stock drops. Okay, so you do the math. It's either 5.2% or 5%. Anyway you look at it, this is, and not including of course the risk reward. So if you're talking risk reward, the risk is in this case 60 cents, let's call it 70 cents. The move is nearly $10. That's not 10 to 1, that's like 13 to 1. Please show me a trade like this, and once we go live, anybody that listening to me or watching this video, once you're gonna go live, hopefully next week. We try to do it this week, but we need more practice with that. So we're not gonna go live before things are at least as we believe 100%. So you are live. And you can write down this trade idea, or I will write down, and there are enough shares for everybody. Okay, just to make a point, when the stock breaks down, you can see it for yourself. 100 volume is 182,000 shares. Is it 182 or 18,000? I'm not sure. No, that's 182,000 shares. And the overall trading volume yesterday was 16 million in this Corway. Okay, so the liquidity is for in this case, you know how many shares we need to buy for this move down? 125 shares, if I'm not mistaken. And let me just do the math. 20,000 divided by 145 equal 137 shares. Let's call it 140 because we round up everything. 150 shares. 150 shares. That's a miserable zero volume versus the volatility and the liquidity and the volume per cent in this stock. So there will be no slippage on a limit entry at 150 shares. Definitely not with the market order. So, and if there will be a slippage of 3 cents, who cares? Or 5 cents? It's negligible. Okay, guys, I hope it was illuminating enough. I planned this video to be for 20 minutes. Ended up talking too much. It's 40 minutes, which is a lot. My mistake. Sorry about that. If you're hanging until the end, I hope it will pay you. Eventually, one trade like this and it pays for your time here. Okay, thanks a lot. Do like, subscribe, it's important to us, and we'll see you in our next video.